Office hours has started. What always makes me feel happy when I click that button and we go live is that I know weekend's coming, and that Saturday and Sunday I can work without anyone interrupting me. No, no
Tom,
one butting in,
do
no
you ever
emails.
take time for yourself? Is there ever like, I know
Well,
we haven't gotten you to leave the house lately, but do you at least go to a different room?
if I do that, then I have to deal with children and wife. So that's even more stressful. I'd rather work.
Understood. Okay.
And I tell them, here, just go. Here's some money. Go to an activity. Go to an event. Go do something else. And they're like, yay! And they don't even remember that they don't see me. It's great. It's what I want.
Until later, what happens later when kids are like, "Hey, how come you never came and hung out with us? Like, where were you all the time?"
Excellent. All right. Well, we have a small crop of questions this week, but doesn't matter. Every question is a good question. I did want to mention, because of the last Friday
Mhm,
was when the CrowdStrike issue was happening, with all
mhm.
the blue screens of death happening on all the different computers. And remember, we had a bunch of questions that people were saying, like, oh, why is this trade not working? Why is this trade not working? Why is this trade not working? And it turned out, like, we didn't know, like, 10th of the world were had gone down. And so it was uh, it had a lot of effect on that. Like, the what was it? TradeStation and TradeVate, a bunch of trades didn't get executed, and I just wanted to put it on the record that it wasn't our fault, and our systems were up and firing like they're supposed to.
That is correct. Yeah, we did have some complaints thinking that it was on the TradersPost side, but as you look at your logs, like the biggest thing to look for is that one, the alert came through on our side and we translated that into an order with the broker, and then to look at the broker logs to determine what the response is, and that's where we saw, the main issue here that showed up with the CrowdStrike debacle is mostly the broker responses were failing, or all of it was the broker responses failing. Everything on the TradersPost side, was responding the way it should, but it's a tough call to make. It's hard to tell sometimes what's happening in the chain of events.
We should put on the homepage for TradersPost that we are CrowdStrike resistant, and so that way people could also filter for that.
That's a badge of honor now, I guess, right?
That's right.
We're not running on Windows 3.1 anymore.
All right. So the first question we have here it has to do with buying power. So this person was asking, why does my dashboard show enough buying power to open a position on the trader's post side, but the trade still gets rejected for insufficient funds on the broker side? So this comes up every now and then, and the buying power that we see in the dashboard is what's being reported to us from the broker.
Right. So the buying power isn't necessarily like, this is why we label it as cash in many instances. I don't actually think we label it buying power. I could be wrong about that, but um, it's not actually your buying power, because we're most likely talking about a margin requirement situation here, where, for example, if I have a fairly small futures account, let's say I've got $2,000 in the account and I already have an open position in NQ, for example, I have very little available margin at that point, and I'm likely going to bump into a margin requirement issue, even if I try to take a smaller contract, because the amount of available margin I have left in my account is too small. So, the best that we can do is report the available cash that you have in your account. I know with margin accounts, it's not really cash. But what we're reporting is basically the available cash there. If the size of your position exceeds that available cash and you don't have enough margin, then you're likely going to get a rejected trade at that point for insufficient funds, because we don't actually track your margin or your margin requirements in your account. We are only able to report basically just the cash position in the account.
Excellent. So I just want to bring that up because there are limitations sometimes to APIs, and as much as we might want it to display exactly what you're talking about, we can only display what's being sent back to us.
We should clarify. I mean, we can probably display the margin requirement information. It's a big lift to do that math and to show that in our interface. So at the moment, we're
Oh, I
basically
see.
accepting trades, or we're not doing any checks on our side to see if the trade can go through first, which is why you see a rejected trade. We're allowing the broker to decide what your margin requirements are.
I understand. Okay, makes sense. This was another question that came up. Why do my initial take profit and stop loss get canceled when I try to take partial profit from a bracket order? So that's someone who entered into a trade and they sent in the entry price, but also set up a take profit and stop loss. And then they wanted to sell part of that position for a profit as the position was open. But then that also canceled the take profit and the stop loss that was initially sent.
Yeah.
Um,
And this is largely a quantity problem. If I buy 2 contracts or 2 shares of something and I have a take profit and a stop loss set to sell 2 shares on either side, depending on which one triggers first, but then I exit 1 share, I've already invalidated the ability to take a profit with 2 shares and take a stop loss with 2 shares. So brokers typically have a mechanism that automatically cancels those orders out because you've changed your existing position by some degree. In this case, just 1 share. So it's important to recognize that making another transaction will result in having to make another follow-up transaction if you want to finish the rest of the trade you have left. Oftentimes people will write this into their Pine script. Well, they'll enter, they might have the take profit and stop loss. Then they have a partial exit signal, but they need to make one more signal to complete the transaction to exit the whole position.
Excellent. Okay, so the whole CrowdStrike thing really, I'm always very pleased as a developer. Very pleased. Maybe I should rephrase that, but I'm pleased as a developer when I see other programming issues show up in other products, because people have sometimes this idea that if it's programmed, it should never have any flaws. It should be 100% perfect, work all the time, never any issues. But so that led to the next couple of questions we're going to be dealing with. The first one over here is this idea of why is position sizing often considered more important than stop losses in risk management for a number of people? Now, from my end, I remember I could not really get this in my in my noggin until I lost a bunch of money trading. And for me, the size of the position, for me, the stop loss was there, and I thought to myself, okay, I'm protected. I'm going to put this amount. I'm going to be protected, and I don't have to worry about anything.
Mhm.
But then sometimes things happen, and your trade doesn't get executed the way that you thought, or maybe you miscalculated something inside of your account, or something might occur, and then a larger loss happened in my account than I actually realized. Whereas if I make sure that the size of the position is managed at the beginning, that amount, if something went horrifically wrong and it was gone, I would still be fine. Um, uh, then it changed everything for me, even to the point where I go, that account, whatever is in that account, is at risk because it's in that account. And so also there, I make sure that whatever cash I have within a brokerage account, a crypto account, whatever, is what I'm okay with losing. So I sort of like spread my stuff around so that no one catastrophe can ever really hurt me. How do you think about risk, position sizing and risk management in this way?
Yeah, same way. I think that position sizing often ends up being a more important variable than stop losses. Oftentimes, stop losses are seen as, sort of a tried and true method to make sure that you are consistently taking losses quickly, so that the risk reward proposition is set up properly with your trade. But one of the things that doesn't take into account is it depends on what kind of volatility you measure to determine those take profit and stop loss levels. What I see a lot is people have a limited window to build their model from or build their trading strategy from. And if you're building your trading strategy, let's say prior to this week when volatility was at 11 or 12 on the VIX and the size of ATR is relatively small, and you've got these really tight stops as a result, your take profits fair, it feels like, oh no, I'm building my take profit, my stop loss relative to the size of the candles, right? But then we have a volatility event and the size of those candles goes up significantly. We have, shakes in the market. What was it yesterday? The NASDAQ was down 3.5%. That's a pretty
That's
big
right.
sell-off day. And that's going to be larger than the candles you might be anticipating. So you're just going to hit your stops over and over and over again. Position size ends up trying to account for some of that risk a little bit differently, where instead of worrying too much about the stop, which could be a little bit wider and start to account for some of that volatility, at least if I lose, I'm not going to lose as much money. And since this is a survival game more than anything, you're just trying to keep profits. Position sizing allows you to stay in the game longer. We don't want to give up money quickly. We want to gain money slowly, and we want to lose money slowly so that we have some control over that risk and we don't blow out our accounts in an instant.
Even for people like me who take completely unreasonable trades, because I just swing for the fences. You can swing for the fences if you blow out your account. And so at the end of the day, like, the game is how not to lose money, which is
Sure.
so opposite to how everyone how people are pushed when they first start trading. They think, how much money can I make? No, you got to be there so that when the hand is dealt, when the that you can actually participate in whatever is going on.
Yeah.
The for what was it? Before, I used to, whenever I had a loss in a position, I would double that position. And the next time I went in order to regain what I lost, and then and I mean, is there a quicker way to the poorhouse than that? Just doubling, 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 doubling. Whereas when I started having my positions, I had a failed trade. I go back in the trade and I have the position, and I continue having the position. I think to myself, there's no way this could be helpful. But then the position gets to a point where it's stable, and then I leave it for a period of time, a week, 2 weeks, 3 weeks, and now it actually built back up, and it had some time in order to move, and
Yep.
then maybe now I'm back up to where it was before. But to me, it was so counterintuitive that the size of my position was what was killing me.
Yeah, I think that's a great observation. I've had a similar one as well. I think at a high level, it also helped me understand how your drawdown plays a role. And one of the things that I think is overlooked is that losses are more disastrous to your account than gains are beneficial, right? If I have a 10% drawdown in my account, it's survivable. It's going to take about 11% to get back to where I was in terms of break even. But if I lose 50% of my account, it's going to require 100% return in order to get back to where I was at break even. And this is an exponential relationship. So if I lose 90% of my account, it's going to take 1,000% return in order to get back to where I was when I started. So that drawdown factor is a really big factor. Trying to prevent losses, I think, is significantly more important than worrying about your gains for too long. If we can control that risk of downside more, then it's easier to overcome drawdowns, as long as our drawdowns are in that 10, 15% category. It gets a little bit tougher at 20, 25%. But if you know that the volatility of the asset you're trading has significant upside, maybe you're comfortable taking that kind of drawdown. Just recognize that it just gets harder and harder the more you allow your account to draw down.
Every few weeks, I'll go on Reddit and just watch the people's posts who failed miserably because they oversized their position or they got overconfident or whatever, just to remind myself, just to breathe in and remind myself of the suffering that I had gone through, so that I never forget. Because every once in a while, you're like, oh, I'm doing pretty well. Let me just go ahead and adjust my settings, adjust my strategy, adjust my position. I can take a little bit more risks. I'm smarter now. Just absolutely get ruined, get completely wrecked.
We see it a lot, and we talk about it all the time, right? The difference between gamblers and traders. So
Okay.
if you're gambling, that's how it's going to show up.
Speaking of gambling here, so when it comes to earning seasons, so how do you approach automated trading strategies during earning seasons? Let me just ask it this way. Some people are When I used to trade earning season specifically, I was actually looking for outsized moves against what the market was positioned. So I wanted to buy options that I wasn't paying a lot for, and that I had some reasonable expectation that there was a chance where the earnings was better or worse or whatever, and I was placed on the other side. And I really like that. But then I know there's a bunch of people with automated strategies. I even see this with brokers for volatility events, where the idea is not to trade, like to pause your strategies during these periods where you can't. There's no trend, right? The trend could drastically change because of new information that comes out. Is that how you think about it?
Yeah, it totally resonates. I think that ultimately you build your strategy with these types of concepts built in, right? You're taking these things into account. So on one side of the conversation, you might be in the camp of people who believes that I've already incorporated all these things into the history of my strategy. If I built a daily strategy that trades that's been trained on the last 22 years of data, well, then obviously I've incorporated every FOMC event, every earnings call, every change in the market, every regime and so forth. And so I'm incorporating those events into my strategy and have already accounted for them. And I'm comfortable exposing myself to those events because that's part of the results of the strategy. It would be the same, when if you're a dollar cost averaging buy and hold type of investor, that's effectively the thesis you're buying into. I'm buying the market and all of the events that come with it. Now, if you're the type who believes that I want to avoid these types of events because I don't want that volatility in my account, and avoiding that volatility is what helps me increase my edge, then you will need to program that into your strategy. But you have to make sure that you've done it with all the events historically, like every one of them, and you didn't skip any of them, so that you can confirm that avoiding those events is what led to your edge. So either way, either camp you're in, you just have to make sure that you've incorporated them and not given yourself a false signal. If, for example, you built your model with all the events historically, but then suddenly started avoiding those events, we don't know for sure whether avoiding those events actually led to a decrease in your performance.
Fair enough. I didn't even think about that. Right. That's exactly right, because the data set included those earnings seasons.
Sure.
Okay.
Right.
Yeah. Actually, that makes a lot of sense. Do you personally, if I'll ask, this event-based trading, do you like having strategies that are trying to take advantage of earnings seasons?
I've tried. I've tried a couple of like hedged based future strategies that are based around FOMC events. They're really choppy. They're really difficult to get right. They're fun, but not really my style. I've just kind of dabbled in it more than anything. Earnings are important to one of my more long term approaches, but they're not necessarily a trigger for a trade. So if a number of companies start releasing earnings and it results in a sell-off, that sell-off might already be incorporated in sort of the long-term expectations I have from that holding. But if the earnings call makes a significant change in the fundamentals of that business, along with technicals, that might change my opinion about the holding, and I'll exit the position at that point. So it just kind of depends. Like, most of my approach right now is buying index funds, which I don't have to worry too much about fundamentals on, because it's kind of baked in. So I focus mostly on price to earnings there, like the overall market price to earnings, and then mostly look at technicals. So when I see a technical crossover, that's when it's time to get out. And interestingly, I saw a technical crossover earlier this week and exited my entire XLK position.
Wait, you're not long tech right now?
I'm not long tech right now.
Yep. Jiminy Cricket. Well, what I like about what I used to like about earnings season trades was that the business cycle, even the liquidity cycle, earnings seasons was affected way later, because it would take some time for that to filter through the businesses. And so at the turns of the cycles, you can a lot of people are positioned offside of where the earnings should be, and then you get these surprises either to the downside at the beginning of a recession, or the opposite at the bottom. And there's also something so satisfying of everyone's expecting this to keep going up, but you bet that it's go down, and now you made 10x on some options trade on the downside. The problem I had was that why I stopped was the rebounds that would happen. Like, I guess liquidity profiles for the markets has changed over the last 5 years, that you can get a complete reversal of whatever move happened right after earnings. So it's like, well, how long do you hold your options? And there's nothing so painful to me as having a position where I'm up a certain amount, take profits, and then it continues to run. So then I go, well, I don't like this, because I never know when the bottom's going to happen. Sometimes it could happen on a dime, and it was just too painful to win, but not as much as I could. And so I forget it.
I totally get you there. And I've been there plenty of times, exiting positions too early, and then the market just continues to rally like crazy. Pulling a stop too soon, and there ended up being a reversal, or taking the stop too soon, and it ended up reversing immediately after. If I had held, it would have been a winning trade. This is the game we play, though, when we try to time the market, and we're not always correct. So we just want to be right more than we're wrong. So keep at it.
And you can't brag. You can't brag to anybody that, hey, I did this trade. You'd be like, oh wait, that trade that actually went 3 times further than you did.
Yeah, right.
Oh, okay. So you're just a coward. You can't even. Why even bother? You're happy with 7%. That thing moved 30%. I was like, oh my god. All right. Well,
if that's how I measured myself, I'd be a pretty depressed individual. So unfortunately, I don't use outside opinions to measure my portfolio performance.
I see. Well, by outside opinions, I mean my wife.
Oh, right. Yeah. Got to keep the wife happy.
Yeah. She looks at the chart and she goes, you've been watching this for the last 3 months and the trade finally happens and you got 1/3 of it. Yeah. All right. Back it up. Go to something else.
Yeah. My wife, as my advisor to my portfolio performance, is always the type who's like, why did you even sell in the first place? Just hold forever. She's very much a hold it forever. And that's mainly because of my 2012 Amazon investment that was fairly large. And I pulled it like 2 years later, maybe 2.5 years later. And I should have held that forever, obviously.
Oh my god, yeah. Yeah. I had Tesla stock earlier on too, and then it was like, I guess I got not confused. I got into the hype of short Tesla, short anything EV cars, and then I started shorting the stock, and every single time I shorted, I lost. Single time, all the way to the top. All right. So this is something we do mention this term constantly. So I thought it might be nice just to specifically describe what it is, and that's what a tail event is and why they're so important.
Yeah. So if you've taken a statistics class, we're talking about basically the distribution of returns from your asset. There's something called the empirical rule there, which is basically referring to the first 3 standard deviations of the distribution of those returns on the positive and the negative side. So the first standard deviation represents about 65% of the data, and then it's 95%, and then it's 99.7% of the data once you get to the third standard deviation. Now, the interesting thing about markets is that they are not normally distributed. So they tend to have kind of a positive skew. The markets tend to go up more than they go down. We know that's true. But the tail events are really random, and they can show up in weird locations and oftentimes represent what we would call 6 sigma events, which a 6 sigma event is basically 6 standard deviations from the normal returns we would see from the asset, like the S&P 500. So what makes investing very difficult is trying to capture all those probabilities as best we can. But because they're not normally distributed and because they are sometimes very random, even when we've built a model that tries to capture that volatility, a different type of volatility can show up than we accounted for. A bigger sell-off occurs than what we accounted for. A larger event occurs, or as the phrase I've heard you use before, Tom, is a melting up situation might occur, where on the positive side of that distribution, there might be a bigger event that leads to a huge upside that you missed out on, or maybe you were short the market and it just went against you in a really significant way. So those tail events are something that you can try to account for through various types of strategies. Some people try short side strategies, hedging with futures. Sometimes you can use options contracts in order to try to, buy deep out of the money puts and account for some of those tail events that no one's expecting, largely kind of trying to bank on the possibility that there's a panic sell in the market that was unaccounted for in most people's view of the market, which is, again, I think I talk a lot about volatility. Oftentimes, I think people's trading activity represents a very recent reflection of where volatility lies. And they don't tend to look at the whole picture. But even when you look at the whole picture, you're probably still not accounting for what can still happen in the future. And that's kind of the point of tail events. We don't expect them to happen, but they can still happen. And I think you've mentioned before, Tom, they happen more often than we realize.
Yeah, one of the fun things about tail events is that because especially markets, they're a dynamic system that are interrelated. And so oftentimes a tail event that happens in one place will then make another tail event that was also improbable more likely to occur. And then you can have this cascade effect. A classic example for this was the COVID one, which I got completely caught up in, where you had this event, this global pandemic. So that's a tail event. then the market drops. But because of the gamma within the market, the way that the dealers have to position themselves, there's this exacerbated move towards the downside, because as these put options became more valuable, the dealers had to then hedge the positions more and more and more, and then you head down. But then you get to a point, so then you go, well, that should just continue. It should just keep falling down. But then there's the response function of the Federal Reserve, of the government, where they go, well, lockdown, let's start pumping money in, give people checks, do whatever necessary in order to keep the economy going, and then that liquidity comes in, which itself is a tail event as well. Trillions of dollars suddenly being pumped to the market, that's not in our back test. So then it's just this one after the next after the next after the next. It's like flipping heads on a coin 500 times in a row. It's improbable, but if it does happen and you bet against that, well, now you are in a heap of trouble. And then we had that whole V, and then up to all-time highs during a lockdown of the world.
Which I would count that as another tail event, right? It's a positive tail event that no one expected to happen.
Exactly. And so then you have the wealth effect that happens after that, because the markets went up and then more people went in, and now we deal with inflation, which we haven't had for or core inflation that we haven't had since the 70s. So it's just these chains of things, because all these systems are connected to each other. The reason I mention this is that that's why if you understand tail events as actually fat-tailed, that they happen actually more often than you think, that's where sometimes as a retail trader you can actually get an edge, right? You can try to find some sort of edge, or as Kim Carson talks about it, a lean. Maybe you don't have an edge, but then you notice some sort of dynamic happening, and you can lean into it, because you can imagine it actually goes further than you actually think, and that's a way of capitalizing on these things. But if you if you only think about the trend, and you never really you never see those tail events as, I should expect them to happen, and to take advantage of them when they happen. So, for example, like the GameStop, the meme craze was a tail event. What is this? The retail market got together in order to squeeze hedge funds out of a position
twice,
and then it happened twice, exactly. Yeah. And it's so I remember when it happened the first time, I go, well, no, this is too incredible. Like, I shouldn't pay attention to it. But then if you use those tail events as, you think to yourself, well, that's going to cause a ripple of volatility that'll spread through these dynamic systems, then you know there's probably going to be other things. Just like the earthquake over here might cause a tsunami over there. And so I completely discounted the tsunami, because I just looked at the earthquake and I go, oh, that's crazy, not realizing, oh no, there's a wave now, I can actually surf. I discounted it. So understanding fat tails, recognizing them, and realizing that they are not necessarily something to be avoided, but to be used as part and parcel of your trading experience, can be super valuable and very rewarding to study.
Yeah, I totally agree. I think maybe this week's events have actually been sort of an example of what I try to pay attention to, especially in low volatility environments. When the VIX gets down to 11, 12, that's like really, really low environment. That's usually the calm before the storm. And we saw the VIX rip up to almost 20 yesterday. I'm not sure. I didn't even look where it is today. But those types of changes are sea changes that can create an echo in markets, in my mind, where that event where you see a sell-off, you might expect there to be some form of a sell-off, because we started breaching technicals, we started breaching some crossovers, and so on and so forth. But I don't think we expected this big of a sell-off, which is why I like not just tail event analysis, but really trend following in general. This is the reversal of a trend and the beginning of a new trend, and it has some strength behind it that's coming from the market. And this is a great opportunity to ride that wave once you see it coming in. It feels a little bit like being a surfer out on the waves, and you're just sitting there, and there's calm. It's just a calm environment, and you've got 60 guys out there on their boards, and they're just sitting there on their boards waiting for something to happen. And if you're out there waiting on your board, and you've got the idea of exactly how you're gonna surf, then when that wave comes, you're ready for it. So
that's exactly right. So I'm looking for in this dip, I'm looking to buy assets, right? Because then
you're waiting for a good supply zone to show up.
Oh, I actually, for Bitcoin, before it rose the next leg up. Like I just been buying the dips there because the overall trend of liquidity is up, and I'm expecting a recession to hit next year. And what does that mean? Well, liquidity is coming to the market, and so
there you go. There
for me, every drop is an opportunity to buy.
Well, this has been a good one, that's for sure. The Bitcoin's certainly rallying pretty hard again, which is nice.
Peter here says, I'm proud of myself for not making jokes about tail events, which sounds like something out of a seduction seminar.
Seduction seminar. I need to talk to my wife about tail events.
All right. So my last point over here, this is something I was curious about your opinion on. What interesting data on TradingView can be used to filter trades? I love to bring one up that I don't think a bunch of people know about, and that's the VOLI index, VOLI. I know you're mentioning the VIX, but whereas the VIX will provide a the VIX is based on a wide series of options for different time periods and different strikes. VOLI is almost like the VIX, but more narrowly focused. It's narrowly focused to 30 days out and at the money assets. So some people will use even the ratio between the VIX and VOLI in order to get an idea of the bullishness or bearishness of the market. But I thought it was very interesting to be able to have something within TradingView that can be used to help filter out if this is a good time or bad, is this a bullish time or a bearish time? Because the VIX, there's been all kinds of issues with VIX and VVIX and all that over the last few years.
Or even VIX 1D. The 1-day VIX is less helpful than I thought it would be. It's pretty noisy.
Yeah. But VOLI is pretty interesting because it's more narrow. Are there any any assets like that or non-tradable assets like that you take a look at in markets?
Sure. I mean, there are like right now I'm using a measurement of some of the top NASDAQ constituents as part of a signal for where I think price action might show up in futures on NQ or MNQ. That signal is mainly just looking at the individual price action of the top 20 constituents of the NASDAQ 100, which I recognize is like, okay, why 20 of the 100? Why not all 100? Well, one, TradingView only allows you to use request security up to a certain number of assets. So I can't capture the whole 100. But two, I think the top 20 NASDAQ constituents represent like over 55% of the entire market cap of the index. So what's the point in the other 45 anyway? So yeah, that particular signal is helpful. It helps me understand what's moving price action, but it's not necessarily a trading signal. It just contributes to a filter for whether or not I think price action is most likely to go up or down around VWAP. Essentially, it is measuring the individual VWAP of each of those 20 constituents, along with a couple other price action signals I look for.
Two of the things that or one category of things that I pay attention to all the time and I love that TradingView has is the access to the Federal Reserve economic data.
Right.
And so stuff like we've talked about
unemployment
before,
rate or even the Fed funds rate. Sure.
But I also like the is it the PMI? Oh, did they change it? Yeah, so I love this the PMI index because it's a great proxy for the business cycle, right? And anybody can see this goes up and down in this nice little sine curve. And generally speaking, when you're at the bottom, moving up, you're headed towards good times, an expansion within the markets, and then down the other way, recession. So that's all I find to be very fascinating, very interesting. But the one I use all the time is the NFCI. The financial conditions index is like super useful whenever the price is heading lower. It's credit is more free flowing, money is more accessible, and it's bullish for markets. And then the opposite when it goes up. So and I love that in PineScript, in TradingView, I can filter certain signals accordingly. All right. So I just wanted to mention that because I know it took a few years before I even realized that TradingView has more than just assets within it, and they keep adding more and more things.
I think that's a big takeaway from the idea of filtering in general is to look at some of the other indexes and indicators that are available and pull them in through the request.security function so that you can couple them with how you're observing the technicals or fundamentals of whatever it is that you're trading. And if you can find a relationship between those two, it'll show up on the charts, or at least in the strategy performance that you're evaluating.
Excellent. All right, so that's it for the questions for this week. As always, it's fun to talk to you, Mike. And
likewise.
I will continue. Oh, we have after hours coming up, so let's go ahead and record that. But as always, if people have any questions, they can always post it, and we'll look forward to doing this again on office hours for TradersPost next week.
Cheers, everybody. Have a good weekend.